right, good afternoon, everybody. This is event trader Gavin McGuire being joined by chart trader Brett Manning. Brett, are you there?
Yep, sure am. How you doing, Gav?
I'm doing good. I'm doing good. Getting ready for another episode of the Sentiment and Flow show here. Before we jump into that, you got any thoughts on these Mnuchin headlines crossing?
I'm just picking up on them now. What do you think?
I think that anything about the U.S. being very close to a deal, is going to just raise an eyebrow more than raise the markets at this point. I think people kind of want to see a little bit more constructive moves going on in either phone calls or actual face-to-face meetings before they're going to fall for anything about very close to a deal. I don't know how many times over the last 15 months we've seen a headline like this. So,
Yeah.
not
So I
not
think there's an agenda to continually state that there's a process happening, that it's not, it hasn't just stopped.
Yeah, yeah, exactly. But I mean, I just think it's a throwaway comment at this point, and we're not seeing the market properly, so not react to it. His comments around Bitcoin and Libra were interesting to me. I mean, it kind of follows on what we've seen him say prior, and a lot of skepticism from Congress that we saw last week with the pal Humphrey Hawkins, and we got hearings the next 2 days, so expecting Facebook to get beat up on it. But I know you took a trade, I believe, in the Bitcoin futures a couple of weeks ago. You got any thoughts on that here at this point? I mean, is this something that you'd be kind of avoiding at all costs ahead of these hearings coming up?
My trade, the short side trade, was specifically based on a dynamic that felt to me that it was relatively easy to predict and had nothing to do with a fundamental understanding of Bitcoin. It was the peak of a parabolic increase that had a very easy to spot downside target around the 10,000 area, and it worked out extremely well. The first version didn't. That was a very tight loss. The second version worked out extremely well, and it was in really for a move that, when it actually caught hold, took about 30 minutes for a couple thousand points.
The interesting aspect being you were basically looking at that move and finding parallels to the Japan indices a couple of years back, right?
Exactly right. Yes, exactly right.
So yeah, that was a nice trade. So now we come to the Sentiment and Flow show with earnings season upon us. So it feels like every time we're meeting here, we've got something on the horizon that could impact things. But I think so far it's been playing out how we looked at it in terms of the positioning just was leading way to a little bit of a press higher, and we've obviously seen that play out in the markets. Now, when I look at the sentiment data from a sentiment trader side, this time around, and we'll break into the some of the Bank of America data that we got last week. I'm seeing a little bit more of the excessive optimism popping in. Now, I can't say that we're seeing any sort of a FOMO trade by any stretch, but there is a number of the indicators, and we'll break into each one and get your thoughts on it in general. But some of the activity that I was seeing in the put-call ratio, where I saw calls were outpacing puts by the most in like 3 or 4 years, I believe it was. So overall, your general take on some of the sentiment readings that you were seeing. Are you seeing any marketable change, or you think that we're pretty much running in the same light?
I actually think that you can make a pretty good argument that very little has shifted. When you talk about the puts versus calls, if you look at the two buy to open ratios, the Lobo and Robo, they're still in extremely neutral ground. The main one that shifted powerfully was the SPY liquidity premium. And we've talked about this in the past, and the fact of the matter is, historically, it's a very bad top calling indicator. It's a very good bottom calling indicator because it shows when people have such an extreme of fear about the possibility of a crash that they shift to trading only instruments that have massive liquidity, so that in theory they could get back into cash as quickly and easily as possible, no matter what's happening. So that's really the basis for the indicator. When people just shift to trading things like the SPY over trading the individual stocks that make up the S&P 500, it usually is a sign of extreme fear, and it happens during a market panic. And that's a very good indicator, a bit like a crazy put-call ratio. When you start to see puts, twice or three times calls, you kind of see the same situation. It's these sort of panic indications. But it's a very bad top calling indicator. When you see people really willing to trade the individual stocks versus trading the SPY, you'd think that might be a sign of complacency, that there's no chance of a crash. But it turns out that the idea of no chance of a crash doesn't necessarily mean complacency in the way that tops are usually made of. Good example is February of this year. We saw it at the same levels it is now, and the only thing that happened then was a 10% steady rally to the upside. We saw almost the exact same thing in April of 2018, and again, almost the exact same thing in June of 2017. Basically, the same readings as now, followed by about a 10% rally. So,
let me ask you what, because the last time I saw it in this over the excessive optimism line was May 2nd. We did get a little bit of a roll back then, but you're saying that's the exception, not the norm?
Yeah, right. I mean, you can see it barely dip into there, but you can see, if you're looking at the chart, if you look back to February of this year, you can see a much greater, much deeper level of so-called complacency, and then just a straight-up rally. And if you look back to last year in about April, you can see the same thing.
Yeah.
Early on in a rally, it gets
as
to this
opposed
level,
to the May where it barely got into the excessive territory.
Right, and if you go back to 2017, it got to the same level it got in May about 6 or 7 times, all during a rally that just kept on sprinting higher. So I would say that you can't really suggest that there's a causality to the reading it had in May, because that's superseded by so many different versions of the same basic level being followed by a sharp rally. In other words, it doesn't suggest that people are over their skis in terms of positioning. It may be that they're free to trade individual stocks because they don't see a crash headed their way, but that doesn't mean that they necessarily are jam-packed with leveraged positions in those stocks with no kind of hedges and margined up in their accounts. It just means the trading action is in those stocks. So I think it's out of a panic, but not necessarily into a dangerously speculative situation.
Okay, so let me ask you touched upon the Robo and the Lobo, and we see them firmly in neutral ground
Right.
at the moment. Now, how does that differ from the option speculation index? Because that's one of the things that I was looking at that was showing a move more into that excessive optimism. And, as just mentioned, we talked about call ratios firmly outbuying the put ratios at this point.
Yes, so I would suggest that the difference between those two is probably important, because the one thing that we know that they differ in is that the Robo and Lobo are buy to open. Right,
Okay,
and I'm not sure that the option speculation index is, which means it may be the other side of positions that were taken during a period of market panic. So rather than speculative options positions on a big breakout, that people are closing some of their positions that they were taking to protect themselves on the downside, it does say something, but the fact that there's not a lot of excessive speculative activity on the other side, we would see that, I think, in the Robo and Lobo ratio if it was there. Now, maybe not. Maybe, we're going to look back on this as an example of how the two, but at least I see them as kind of balancing out to being something that doesn't really put me in a difficult situation as far as making a determination here that we're not in an overly speculative situation. And always remember, I think for everybody, the most important part of looking at sentiment data at all is that you only draw conclusions when you're seeing extremes. And anything else it's just not a factor. It doesn't mean that middling sentiment doesn't mean buy the market because it has to get at some point to extremes of bullishness. But it does mean that sentiment data alone is not the reason to believe that the market is in a particularly vulnerable position. And I think if you look at Robo, Lobo, the 4-week AAII bull average, the hedging index, the flows, which we'll get to, and the fund manager survey, they all kind of jibe together in a picture that remains to be pretty much what we've talked about, and I don't think it's changed all that much. Maybe there's a little bit of a little bit more of a very short-term, fast money, speculative activity coming into the picture? Maybe not. I don't see definite signs of that. And I certainly don't see a market that's super pessimistic. It's not an extreme the other direction either. But I don't see anything here that says sentiment data is starting to flash a red light for this rally. I don't see anything that justifiably makes that case. Maybe the option speculation index, as we've just talked about, the SPY liquidity premium probably shouldn't be treated that way. So the best case you have is the option speculation index. Right. And that stands pretty much alone in terms of the genuine market sentiment and market positioning based indicators. You can certainly make a case with other things, and I want to talk about this in a few minutes, that there are some other types of indicators that I think are making some signals that are improper in terms of how they're being analyzed right now. And I think it's one of the reasons why we're seeing such caution toward the equities market. But as far as the sentiment data overview in and of itself, you can make a case that the option speculation index is starting to show a little bit of a red flag. But for me to say that we've got a signal would take a number of different indicators showing unequivocal extremes that suggest a real rise of speculative fervor among different groups of market participants. And I don't think that we can come anywhere close to making that case right now.
Right. There was one indicator that struck me as kind of fallen into that realm. And if I'm touching upon any of the ones that you wanted to mention, by all means, let us know. But the advisor and investor model, which is basically a conglomeration of various newsletters, has moved into that excessive optimism area too. Is that anything that raises your ire at all, or do you just see that as basically writing without a lot of follow through in terms of the actual positioning?
Yeah, I mean, I guess it's getting there a little bit, and I suppose that you have some. One of the other things that I've noticed, and investors' intelligence tends to kind of work this way a little bit too, where you see sometimes people who write analysis pieces, they get kind of forced to go with the trend because they're sick of top calling and being wrong. And in a way, it makes them almost more disciplined about being a trend following market participant than some of the fund managers who still kind of hesitate to get involved. So if you see a lot of people getting bullish in their newsletters, sometimes it happens around the top and coincidentally, but I think a lot of times it ends up being a reasonable trend following indicator. And if you look at that particular index going back a few years, if you look at where it started to show bull readings in 2013, on the early side of 2013, and right ahead of a 30% rally, and staying in that bullish area for most of that rally, and again in 2017, it kind of got up to where it did in May. Now, this time around in May, it did do a decent job of correlating itself with the highs that we saw. So perhaps it's in sync with the market that way, and maybe you can make a case that kind of, along with the option speculation index, puts us in yellow light for the trend right now. The only reason I would say maybe not is because it's also got to be placed in the context of where we're coming from. And I think where we're coming from is best defined as two very deep extremes of pessimism, one right at the end of last year and one again basically right around the very beginning of June of this year. It both had multi-year extremes of deep pessimism and really strong calls for, almost like bear market bottom kind of sentiment readings. And we haven't seen the other side, like a counterweight version of that kind of sentiment at any point since either one of those. We've gotten up to middling, and we've maybe gotten a couple of little sort of minor red flashing light moments, but we haven't gotten, usually I think you end up seeing really the other side, a counterweighting version of that kind of situation, because people eventually throw in the towel and dive in before you can get a serious high. But as we always comment in these conversations, sentiment is only one piece of the puzzle, and if the macro context deteriorates dramatically enough, all this is academic, because that's still going to gear where things move. It just means that the deck is stacked against you if you're trying to persistently short this market, because the vulnerable money is more or less still, I think, hedged in on the sidelines to a great extent, and it's vulnerable to being forced back into the market by better than expected macro outcome. Regardless of what we know about what the macro outcome is going to be, if you just know probabilistically that the greatest vulnerability to market prices is possibly to the upside because suddenly things start to look rosy, I think that that's something you can fairly confidently say right now, rather than that the vulnerability is to the downside because there's so little appreciation of downside risks. And I think that when you start to pair all this analysis up with what we see with the stuff that we see like in the flows of capital, that we're still kind of sitting in a situation where we've seen way too much move into defensive instruments and into sovereign debt.
Right.
And what you see in terms of fund manager positioning, that they're still very hedged, they're still very cautious. I think you can still make a case that if things were to suddenly look really rosy, it would still foster the most dramatic shift than things looking a bit more bleak. But obviously, just like we talked about in our strategy meeting last week, the downside risk is still that we start to spiral into a contraction, and that's still going to be the most important thing happening.
Right, and we'll get into that a little bit later. Um, First, let's go with the last sentiment reading that I wanted to point out, Brett, and that'll
Okay.
act as a nice segue into our positioning, because this was one that caught me off guard considering all the positioning that we're seeing, and that would be the hedge fund exposure, which I'm seeing come to its biggest extreme since February 2nd of 2018. Of course, that was shortly after Davos and kind of the initial salvos of the trade war that we saw out from President Trump and his administration and commentary there, and really led to a rollover in that 2018 period. So this hedge fund exposure, explain to me how this matches up, because I don't see it in the flow data that we've been looking at. So I'm
Right.
curious as to where this reading is coming from, and basically so people are aware, this is basically an indicator based off of a composite of hedge fund tracking indexes. It compares the index of hedge funds exposure against returns in the S&P 500 to see how much exposure hedge funds appear to have to the stock market. And again, this has popped into that excessive optimism territory, and it's given us the highest reading since February 2nd of 2018. So this would I guess what confuses me on this, Brett, is it doesn't seem to relay what we're seeing in a lot of the actual flow data.
Right. And it is, I think, the big mystery, and it's possibly the biggest one that could start to be confirmed by the flow data if we were to see that. So just so people understand what it is, it doesn't necessarily tell you what hedge funds are doing. What it tells you is the degree to which a hedge fund tracking index, a benchmark built for hedge fund evaluation, is how closely correlated that is on a day-to-day basis with the changes in the S&P 500. So if something like the HFRX ends up, going up 0.3% on the same day that the S&P 500 goes up 0.3%, and then the next day they both go down 0.16%, then the score of this indicator is going to go up a lot, because it's showing that the hedge fund tracking index is highly correlated with the S&P 500, and the inference that one makes is that the hedge funds must be highly levered to the S&P 500 in a positive way. So highly long side levered to the S&P 500. That if that were the case, then it would cause the cumulative tracking index for how hedge fund performance is going on a day-to-day basis to match up extremely well with how the S&P is doing on a daily basis. So that's what it's doing. And it's jumped to the upside, and it has jumped to the upside, I think, relatively in line with firm expectations coming into place for the Fed cutting rates. I think that that's a reasonable hypothesis, which would suggest that hedge funds are starting to push into what I would say is probably kind of like trying to make sure that the market doesn't take off on a blow off leg without them, and that's
And that would
important. And
and that would be shown in the option activity that we are just talking about.
it could be that the two are actually being defined by the same exact dynamic. In other words, that the options speculation index is moving because of a large number of hedge funds putting a large amount of money into calls on the S&P. That would explain both indicators, and it's not impossible. And that would be something that would reasonably take us to a situation where we start to look for consolidation, and it would give us a sentiment basis to start to say the same thing that we've been saying a little bit anyways, which is maybe we see a pause through earnings season. And it's kind of what my base case is. If I were to draw what I think the future of the S&P 500 is, this is not saying that this would be correct, but if you had a gun to your head and you had to draw it, what I would draw is a lateral consolidation right now for about the next 3 to 5 weeks, and maybe a couple of little dips. And then I'd want to see that there is that larger fund manager bid coming in underneath it as people start to get the sense that maybe we're not headed directly into recession, and maybe that we do kind of have a have your cake and eat it too Fed right now, where you get to see an easing cycle in the midst of relatively decent economic data. All of that is possible too, and I think that it syncs up reasonably well. But yes, you can make a case that let's say we now have a yellow light on this trend because of the option speculation index, along with what appears to be rising participation by hedge fund controlled money.
Yeah,
I can agree with that statement.
That's basically what I'm gathering now. As we go in, we talked about the hedge fund positioning here, at least that sentiment reader, and we could break into the flow data and circle back around, because I agree with your take there on earnings, and I think we kind of saw an initial take on that with Citigroup, and a few things that I wanted to point out on the Citigroup earnings that are going to be worth watching over the next week, and I want to get your take on it too, Brett. But as we go over into the actual flow data, last week, weekly flows, another big flow into bonds, about $9.6 billion according to Bank of America, $0.6 billion into equities, and this is, of course, again, with equities going to all-time highs, so one would think that there would be a little bit more flows into that.
But it was positive. It's the first time in a while.
It was positive, and so people get a better understanding of what the year-to-date numbers are, we got about $242 billion of inflows into bonds, obviously reflective in the drop in all the yields that we've been watching here, and $150 billion outflows of equities. So a little bit of a reversal of that pattern on equities. But again, when you're talking about $600 million into equities against $150 billion outflow, it certainly doesn't necessarily match up with what we've been seeing out there. One of the more interesting things I saw in that, Brett, was the Wednesday flows following the Dovish Humphrey Hawkins testimony had investors selling equities,
buying money market funds.
Yeah, and buying investment grade, high yield, and government bonds.
And money market.
And money
$28 billion funds into money market.
Yeah, I found that to be really baffling as well. Because, and I mean, we had the market pushing all-time highs during that, but I don't know, I was just really surprised. Is it just because the passive investor, the passive money managers are buying so much of the equities that it's just kind of providing an overall lift, and that's why we're seeing a lot of big winners and losers on the equity side of things? How do you match up that flow with the actual moves we're seeing in the indices?
I don't know. I mean, I don't know whether it's just people just don't understand the environment and just say, you know what? I mean, I heard this from Stanley Druckenmiller. He did this. Back in May at some point, he just said, I don't understand what makes this market work, so I'm not going to play this game anymore. Yeah. And he just got out of everything. And that was it. And it's like, I'm not going to play this for a while again. And it's possible that people just feel like they don't understand what's happening enough that they feel like they'd rather be participating in a market that they understand better, because it is kind of strange. I mean, you've got people banning about conspiracy theories on why the Fed would be, cutting interest rates with unemployment at all-time lows and all sorts of stuff like that. Like it's a little bit odd. I think that I really think at the end of the day, if you think that the Fed is really, you take away all the Trump stuff and you just say, well, if you're the Fed right now, the main thing that you're worried about is the next 10 to 15 years and where long-term inflation expectations go, because you don't want to see the U.S. gradually become Japan. And you need to maintain inflation expectations above a certain point, or this is what you get. You get compressed down to zero eventually, and that's because that's what people expect, and they start behaving according to those expectations, and now suddenly all monetary policy is just gone. There's just no. You're always going to be pushing on a string then, and you're stuck there. It's like getting stuck in a hole with slippery slides to it, and the Fed is on the lip of that hole, and they're trying to avoid sliding down into it and just being stuck there forever. And I think that that's really what this is about. And I think that they're not too concerned with outside appearances, which is, I guess, to their credit. But I think that the global situations. Let me kind of link this up with another conversation I wanted to have really quickly. I
Sure.
think that there's an interesting dynamic here where there's a lot of variables, a lot of indicators that people watch that are being contorted and perverted in a number of different ways based on what central banks are doing and have done, but they're being misread as other types of indicators. And I think that we live in an age where there's lots of computational models, even at big firms, and there's lots of decisions by committee about how to respond to them. And at the end of the day, when you're making a decision by committee, everybody's sort of in CYA mode and trying to take the most defensible position. It's kind of like in my last chart book. What it's easiest to defend is the thing that people are going to see as most according to traditional logic, because then it's not your butt on the line for making a kind of, a contrarian call or something that goes against the normal ways of doing analysis. And I think that when you see a couple of things, like one, we've got the average junk yield on EU corporate debt is under the U.S. 10-year Treasury yield right now.
Right.
There are 14 different big companies with junk bonds at negative yields right now. And you could look at that as excessive complacency. In the traditional model, that's what it would be seen as, excessive complacency. But we know that that's more about what the ECB is doing that's really causing that to be the case, because of the way that they've moved away from, move up the asset chain for what they can kind of control and move around to try to stimulate things there. They have really compressed all the way up the corporate debt chain in terms of where yields are. And so now you've got EU junk yields under U.S. Treasuries. And another good example is, I don't know if you know about the Japanese post office, but they control $1.7 trillion worth of assets. And they have a servicing fee on an annual basis of over,
Is that dollar
60
terms?
basis points.
Is that dollar
That's
terms?
dollars, not yen, dollars. $1.7 trillion. And they have a servicing fee. They got to get 60 basis points just to break even. And if you think about trying to find something in Japan that yields 60 basis points, it's not easy. So what happens is a lot of that money is moved over into U.S. Treasuries over the last couple of years. That's maybe $1 trillion moving over to U.S. Treasuries. And so you wonder why we have an inverted yield curve right now. And that's because of what the Japanese central bank has been doing. And the same thing is coming from Europe. And, yeah, right. I mean, so like people look at the situation and they might have a computational model that says, well, what's the spread, junk to sovereign debt in terms of yields? Oh, well, that's dangerous because, people are paying too much for junk debt. That's complacency. And then also, do we have an inverted yield curve? Oh, that must be signaling a coming recession. And you can combine those things, and you can come into the market right now with a computer telling you that it's a really dangerous situation because people are really complacent right in front of a recession. But both of those things may be really confounded in terms of what they're actually indicating because of how heavy the thumb is from global central banks on all sorts of different asset markets. And yet it may be those sorts of dynamics that are causing people to be positioned in such a conservative manner right now. And I think that that's an important thing to kind of disentangle out of everything.
And the same dynamics push people into taking more risk, too, with the central bank easing process, right?
Yeah, but it might be countered by how aggressive do you want to be when you've got an inverted yield curve and mechanical signs showing over complacency in terms of highly risky assets such as junk bonds.
Right. And when we take a look at the overall read, too, the positioning, as we've been saying, still remains bearish. With that, I saw the Bank of America bull and bear indicator jumping from 2.3 to 3.1 on bullish flows to risk assets. with the
Which
stronger
is still highly cautious.
right, and
Yeah.
stronger equity index breadth too. But I mean that's excess bearish. So I mean, it's like we talk about. We basically got sentiment readings that are moving in excess optimism, and positioning that's still pointing out to everything that's excess bearish. So. You certainly get that dysfunction from the central bank easing that we've seen that you're just discussing about.
Yeah, right. And I think, at the end of the day, it's obviously going to come down to the question of, where do we tip in terms of the cycle variables and, looking ahead over the next 1 to 2 quarters. Where are we at the end of September? Where are we at the end of the year in terms of, the relationship we have with the possibility of starting to tip into a contraction. But people are positioned for it largely since about May, kind of for that kind of situation to evolve, and we're hanging on and now seeing central banks ease further, and the market is trending up in a way that I still feel like puts us in a position where we've got greater chance that things start to look a little bit better than people were expecting, and there's a bunch of money on the sidelines that needs to find a way into greater exposure to the stock market. But we may not have quite as far to go as I may have thought before, particularly with some of the indicators that we've just talked about.
Not as far to go in terms of a blow off top type move.
Yeah, I mean, it's possible that it could happen relatively quickly without covering that much ground. But it still looks like a situation where we're more vulnerable to a spiking acceleration to the upside before we saw any appreciable downside. I would still be, it still keeps me away from shorting. I guess one of the most important parts of all of these conversations that we have is what I'm trying to relate is the degree to which I'm keeping myself from trying to short the market.
Right.
And,
yeah.
I'm still 100% avoiding that kind of what I would see as a trading error right now. This is the type of thing that can kill you over time.
Yeah.
If you see a market like this and you just keep trying to pick that top,
it's like one of the best well laid potential bear traps out there. It feels
exactly
like.
Right. Yeah, that's exactly right.
And so let's break into a little bit of the sentiment around earnings, because I know I was getting a lot of feedback questions on Citi, and I think both of us are kind of in the same camp in our expectations, at least in the early part of earnings season, in which I mean, we have a forecast for the first earnings recession in a couple of years here. By that meaning, earnings per share is expected to be negative on a year-over-year basis. We'll start getting some more insight into that. Certainly, some areas.
2 straight quarters, right? If it's true.
It is, but we didn't get it last quarter. So, I mean, right now it's the boy who cried wolf with this earnings recession. It was expected to be last quarter, but we ended up getting, I think it was plus 2.1% year over year.
Oh, I saw somebody else put out a note saying that they believed that this would be the second straight quarter.
We were expected to get it in Q1, and it never came to fruition. Now, it was very light growth. But I don't know if perhaps we're looking at it differently from a GAAP versus non-GAAP perspective on the earnings per share basis.
Yeah, I wonder where I saw that.
But
okay. So we were barely positive in Q1.
Yeah, and we're looking at a minus 2.3. I think is currently if analyst consensus expectations are on tips. So we did not get a negative EPS surprise on across the S&P last quarter, though. It was slightly positive. So and you do need 2 quarters in a row for it to be a recession. So perhaps I should restate that as earnings per share year-over-year decline. I think I got to double check the numbers, but looking at a 2.3% decline when looking at earnings. But of course, on average, EPS usually tends to beat by 3%. So, if you take that number in, I wouldn't necessarily say people are looking for a negative decline in earnings as much as we would be, say, looking for a flat year-over-year number. But what it brings back to is some low expectations going in, and we talked a lot about it in the last Sentiment and Flow show. We're seeing the greatest divergence between downgrades to upgrades ahead of earnings in, I think it was 9 years. So that dynamic continues to play out there, lowering the bar and expectations going in. But I found the Citigroup And I know it's just one bank, and I'm really looking forward to getting into the J.P. Morgans and Goldman Sachs is tomorrow, Wells Fargo as well, Bank of America Wednesday, Morgan Stanley Thursday. And with that backdrop too, we're going to have a lot of transports coming out, and we got JB Hunt later on today. We have a few more airlines, and most of the railroads, which makes up 33% of that IYT, are coming out this week with CSX, KSU, Canadian Pacific, just to name a few. But the Citigroup results were decent. They ended up beaten by, we'll call it 3 cents. We'll take out the trade web boost that it provided, and they also did get a pretty meaningful boost on that 12% year-over-year growth. 10% of it was due to share buybacks, and then they also had a little bit more of a favorable tax basis too, which I think was probably some of the reason why we saw a little bit of a roll of Citi. But I was really impressed to see the top line beat and the beat on loans, which is really where I would have expected to see a little bit more weakness there. That would have been reflective of a oncoming recession, if you will. So I want to see if we get that across, but the reaction at Citigroup today was pretty interesting too, Brett. And I kind of think that we could see it as a mirror for the entire markets and earnings season, where we saw that selling in reaction to some of the news, but then the buyers were quick to buy in. So I'd be curious as to your thoughts on Citi, and what you'd be looking for in this first week of earnings as we get those transports in, we get the banks and a couple of big tech names like IBM, Microsoft, Netflix coming in. You talked a little bit about how you're a little cautious around the overall macro going into earnings, and I know you're a top-down guy, but going from the bottom up, what is it that you're looking for in earnings more than anything around actual results, guidance, and commentary?
Okay, so first of all, for Citi, it looks like they held on to the gains that they've seen since, let's say, the June lows,
Right.
Which is pretty good because they have clearly outperformed other big bank stocks in the run since June until now. It looks like decisively.
And I should say, making that even
they're not giving any of that back.
And I should say, making that even more impressive, it was a lot due to consumer, which bodes well for the J.P. Morgan's, Bank of America's, and even Wells Fargo's of the world. Not so much for Goldman and Morgan Stanley, but they got a lot of international exposure, which even surprised me more at the strength of the results.
Okay. Well, I mean, but either way, they've outperformed into results, and then didn't get a sell the news reaction because this is holding up. There's that. The big dynamic that I'm expecting is for companies to use the uncertainty that we see that the Fed has commented on a number of times in terms of business investment and business spending as a device to sandbag expectations for the second half of the year, lower the bar, and be able to outperform in Q3 and Q4. So it really is a guidance problem that I would think would impact what we see over the next few weeks relative to what we then see after that. And not as much results. I think that people are expecting, I mean, obviously we've lowered the bar on expectations for results this quarter, and that's an easy case to make. We've seen a lot of the softer economic data deteriorate pretty powerfully, especially in June. And that should suggest that, analysts had every right to downgrade their expectations for earnings for Q2. But I would think that what people would be wanting to sidestep is companies that give guidance, and particularly companies that give guidance that could be impacted by trade, have an easy route to saying we're doing great, but the environment has presented us with some hurdles, so that they can lower expectations before and lower them enough that they can easily leap over them down the road. That it's an opportunity to lower expectations to a level that's easy to beat, where it doesn't look like the companies are operating inefficiently.
Right.
I would think that that's a simple heuristic.
And I guess the question, Brett, is has sentiment kind of gotten too low on that? Because perfect examples of that would be the Micron and FedEx, right? Where
Yeah, no, you're right. It is. It is. There is an opportunity that this actually works in the opposite direction because people are overly expecting this dynamic.
yeah, because like the Micron, people were expecting negative numbers and everything, and then they came out well below expectation, well below what the consensus was. But the stock, obviously, as we saw, ripped higher. FedEx kind of did the same thing. So I agree wholeheartedly that with this kitchen sink type second half outlook that I'd be expecting. But it's tough to figure out exactly how low expectations have gotten at this point.
Yeah, the strategy, if you played it, if you're trying to set up for instance, some calendar spread option strategy to play exactly that thesis, you could really have it blow up in your face because if expectations have gone too far for that type of dynamic and people have all this powder on the sidelines, and then you suddenly get a series of much better than expected earnings and no downgrade in guidance, then you get the exact opposite. If you think of a time correlated kind of series of moves, you'd see a sideways consolidation and a pullback followed by a breakout in front of the Fed in September, kind of ahead of leaping over this bar in Q3 and seeing more easing from the Fed and having passed through this dynamic and vacation time and whatever in the summer, and then you take off, in the late summer and early fall. That would be kind of based on that exact dynamic that I just described and based on the positioning that we've talked about. That would be the strategy. And it could blow up completely in that suddenly that money needs to be put to work right now and chase the market higher because expectations were way too low. And then you blow all that money in right now, and then you start to turn, and the Fed starts to get a little bit tight in front of that next meeting. And, we forward shift that entire blow off dynamic into the next couple of months rather than following them. And, either I think is really possible right now. My base case right now is that we pause, we go through the process of lowering expectations, and then we break out sometime in August and September.
All right. Are you paying attention to any one of the indices more? I know you like to dabble pretty much across the board. Uh, do you feel a little bit more that you're watching the SPY or NASDAQ? What do you think are the bigger reads for the overall markets?
Well, I think, and some of the stuff around regulatory action against some of the biggest tech companies frustrates me almost more than anything from a trader standpoint.
Right.
Just because I would see that as being the obvious place where, it just tends to happen that you start to see when people are really excited about stocks, it moves from the NYSE to the NASDAQ in a pretty powerful way. And you start to see the really crazy upside moves just filter into, a lot of the more exciting and more interesting tech stocks when people start to get passionately exuberant about the stock market. And if this is headed toward a blow off, then the final stages and the most interesting stages would be that kind of dynamic, and that could kind of just kind of shift in some interesting ways if you have this big question about new, really powerful oversight and regulations coming into the mega cap tech companies. So I would answer unquestionably that the NASDAQ would become by far and away the most interesting trading vehicle, but we'll have to see how that theme evolves. And obviously those are big components of the S&P as well, which would shift me toward the Dow futures more probably.
What about small cap, the IWMs? Because obviously they've been lagging. That's been kind of a red flag for people in terms of the ability for the markets to really break out and get that excessive rip higher. Do you feel like until they participate that there's really no way of getting off the ground? Well, not off the ground since we're already at the ceiling here, but to really get that next leg of an extension?
Not really. I mean, we talked about this a little bit in our strategy meeting, that you tend to get a lack of a participation in the final leg from the small and mid caps, and kind of things do filter a little bit more into the large caps, and then the small caps tend to recover fastest after some kind of prospective cyclical downturn. So I could see them never playing catch up, and we still get a full manic blow off in the large caps.
Yes, certainly they had the best inflow going in last week. So, and I wonder if that kind of plays into that SPY liquidity premium.
That's possible.
Because that'd be a lot of large caps, right? So, all right. So, Brett, we leaving anything out here at this point? I mean, obviously there's a million things we could talk about, but trying to keep it in a relatively tight context. Is there anything that we haven't touched upon that you wanted to discuss?
No, I think we pretty much covered it. So, I mean, we've got the same basic situation that we've been talking about, except we've got a couple of, let's say we've got a yellow light version of it at this point, both in terms of coming in front of a possible sandbagging, kitchen sink guidance kind of dynamic during earnings season, plus some signs possibly through both the option speculation index and the correlation for the rolling beta between the hedge fund tracking index and the S&P, that we may have some hedge fund capitulation into the market that's already in place. So maybe we've got a little bit of a yellow light on the upward trend strategy, but not enough to start saying, hey, let's start aggressively shorting things. And then we'll just kind of take it from there. And I think that should be your more or less your overarching sentiment view at this point.
Yeah, so I think one of the things, too, that I'd be very wary of is if, like Brett and I were talking about, if you start getting that earnings roll a little bit and then people think, okay, this is the break, this is going down, I would still be cautious on trying to short into that because, like I said, it just feels like a bear trap trying to go in that direction right now. And
let me expand upon that point because it could be an interesting strategic point to say there may be some opportunities that look like this in earnings season. We get inline numbers and downward guidance in something. We get a big gap down. There could be a reasonable number of situations like that that are good intraday bullish setups.
Yeah, especially for some of those growth stocks that people are concerned about with the valuations, like your TTDs and Twilios of the world and stuff. So that'll
maybe the buy the gap down earnings season.
Yeah, no, that's that. We'll wait 4 or 5 weeks to make sure that we can tag it with that. But I like that as an early thought process for it. So, but okay, well, yeah, I mean, we'll continue to watch this. We'll watch some of the data. We didn't even get a chance to discuss the Empire, which, again, I thought kind of was reflective of the Citigroup, where the sentiment simply seems to be a lot more negative than what we're seeing out on the actual data and stuff. So
yeah,
that's going to be an interesting dynamic to watch, and we'll continue to be talking a lot about this on the corporate side of things as we get the earnings and we get a lot more color from them. But I was really struck by the Citigroup commentary about some of the strength that's going on out there. I still think that the consumer is going to be key, so certainly want to pay attention to those during earnings season. We won't get too many of them this week, unfortunately. But, yeah, no, good stuff, Brett. And I think that's going to do it for this edition of the Sentiment and Flow Show. Obviously, if anybody's got any questions for Brett or myself, please feel free to write in. But we'll both be discussing this throughout the course of the week as things come out and we get a little bit more clues on the earnings side and on reaction to earnings as well. That should help let us know if we're right with our take or if there's a dynamic that we're simply missing here.
Got it.
So, Brett, hey, thanks for joining us here, and I will talk to you shortly.
Okay. Take care, Gavin.
All right, bye-bye.